newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. Donald Trump then has held talks with his national security team, fueling speculation that the US is about to take a more active role in Israel's military action in Iran. Bloomberg understands that yesterday's meeting in Washington lasted more than an hour and was followed by a call with the Israeli Prime Minister. Earlier, the US president had posted on Truth Social calling for Iran's unconditional surrender, saying America's patience was wearing thin. But the French president has warned the US not to force regime change in Iran.
No to military actions aimed at regime change, because no one knows what comes next. Haven't we collectively seen the consequences this has had in the region and beyond? Does anyone think what was done in Iraq in 2003 was a good idea? Does anyone think that what was done in Libya last decade was a good idea? No.
Well, let's bring in Bloomberg's Jumana Pasechi out of Dubai. Jumana, what are the options then open to Donald Trump as we await what seems to be potentially a momentous, potentially an historic decision from this US president?
And certainly people have been waiting to hear what that decision is going to be after President Trump departed that G7 summit early. We know that yesterday he had that call with his national security team. It lasted over an hour. That was followed up by a phone call between himself and the Israeli Prime Minister. There was no readout of that call, no statement put out after the national security meeting. But what we can glean is from his Truth Social post, because if you rewind back 24 hours ago, he talked about looking for something, quote, larger than a ceasefire, i.e. perhaps had reopened the potential for a diplomatic solution, taking advantage of Iran's weakness at this point in time to perhaps push them to sign on to a more stringent nuclear deal. But the tone has changed. Just overnight, he put out several posts demanding Iran's unconditional surrender, calling the Ayatollah an easy target, and also warning the Iranian side to surrender to the terms and using the plural form, the word we, saying we have control of the skies, suggesting that U.S. are somewhat involved already. Now, the question from here is whether they're going to opt for military intervention, what that looks like exactly, what will be the extent of the involvement in the U.S., whether they'll participate in the hitting of those nuclear sites, but then also, Tom, what the justification is, given that the U.S. Director of National Intelligence back in March actually testified to Congress that they did not see any signs that the Supreme Leader, the Ayatollah, had once again authorized the resumption of a nuclear weapon that was put on hold back in 2003. And so both the decision and the justification are going to be key from here onwards.
Yeah, that's really important, isn't it, in terms of the justification and how the US would frame this, if indeed that is the decision they take. Meanwhile, Jumana, I know you've been watching this very closely as well in terms of the attacks between both sides. Is there any sign at all of de-escalation between Iran and Israel at this point?
We are now in a sixth day of conflict. The strikes have continued overnight. Israel continues to target some key sites, air defense sites specifically around Tehran. More evacuation notices have been issued. This morning, they announced that they hit a centrifuge site. In return, Israel has also said that they have intercepted more missiles and drones being launched from the Iranian side, albeit at a slower intensity than the first couple of days of the attacks and the counterattacks. In terms of language, the Israeli Prime Minister has reiterated that he will continue to strike at all sites associated with the Iranian regime. And we heard from the Ayatollah himself. He put up a tweet overnight on X saying that they will show no mercy. We also know that the U.S. Embassy in Jerusalem is closed now for 2 more days. So that brings it to 3 days in total. So to answer your question, Tom, no real signs of de-escalation, despite the fact that many Arab states from the region, Gulf states, have been actively looking to mediate and to bring down the temperature.
OK, Bloomberg's Jumana Pasechi in Dubai. Thank you very much indeed for that update. Now, top US bank regulators plan to reduce the key capital buffer by up to 1.5 percentage points for the biggest lenders. That's after concerns that it constrained their trading in the $29 trillion Treasuries market. Let's bring Bloomberg's Valerie Teitel for more. Not unsurprising, but significant nonetheless that this is the proposal. Val, what is the significance?
Well, look, this is all part of perhaps Trump's deregulation push. Now, when it comes to bank capital reform, this plan has really been long in the making. It seems like we get leaks about this constantly, but the Fed is going to be meeting on this next week. So there are hopes that it gets pushed forward, not just with the Fed, but with other regulators. I think the important thing from this is it seems they've not necessarily decided on whether there should be a specific carve out for the Treasury market. There was hopes in order to aid liquidity in this growing Treasury market that Treasuries would be carved out completely from the SLR, meaning that banks wouldn't have to hold a capital against their Treasury holdings. The problem here, Tom, is that the Treasury market has ballooned in size, and what's not ballooned with it is the balance sheet of these banks having to facilitate liquidity. So that's caused an issue, and it caused a hiccup in the Treasury market back in April, and that's something that regulators are looking to address. They say that regulators may ask the public for comments when it comes to Treasury market regulation. That's maybe foreshadowing of not necessarily made a final decision on the Treasury market side. OK,
to the Fed today, then, fully expected to hold again for the fourth straight meeting. So where will you be looking then, Val? What is going to be of interest for the markets?
It's all going to be the nuance in their updated economic projections, both when it comes to their inflation projections and then in the dot plot. Really, what the market is trying to figure out is how many members of the FOMC think that this tariff-induced inflation will be transitory and how many think that this is going to cause persistent inflation that will maybe bring their cutting cycle to an end earlier than assumed. The market still believes that there'll be around 2 cuts into the remainder of the year. And the base case for today is that we do get a hawkish dot plot, maybe perhaps toning down how many number of cuts, perhaps taking it from 2 from their previous meeting down to 1. But I, for one, would be looking at the number of FOMC members who are penciling in no cuts. And if that number continues to grow, to me, I think that's going to reflect maybe the consensus on whether this tariff-induced inflation is going to cause persistent inflation. I think that's going to be telling in the dot plot.
OK, Valerie Teitel, thank you very much indeed. And what to think about as we lead up, of course, to the Fed's decision and the press conference from Jay Powell that we, of course, will be bringing to you live. Let's get more analysis right now on these markets with a lens also on the Fed with Ursula Marchioni, EMEA Head of Investment and Portfolio Solutions at BlackRock. Ursula, thank you so much for coming into the studio. So we start on the Fed. You are still, you and the team, expecting 2 cuts this year from the Fed. Is that right? What has to come together to get the Fed off the sidelines and bring through 2 cuts by the end of the year?
It's a great question. Thanks for having me, first of all. So, agreed with the view that it's going to be a hold today and the dot plot will be in focus. The Fed has been wrestling with the delta between soft data and hard data for a while now. And so soft data points to sentiment weakening. Hard data thus far, if we think about CPI last week, have been holding up quite well. Yet overnight, yesterday, we saw retail sales, for example, coming in weaker than expected. And so I think there is this element around how is this gap and delta going to close up? Which one of the 2 sides is going to go towards the other? That will be a big North Star, I believe, for the Fed. Now, interestingly, going back to geopolitical tensions that we are observing and news overnight, thus far we have seen the conflict in the Middle East having a relatively contained impact on markets. If you look at Brent crude, 76, still below the average last year. Yet, if we were to see an escalation and, for example, Iran production were to get hit or the Strait of Hormuz were to be closed, I think that it's where you would start to see a transmission mechanism unlocking towards further inflationary pressure and potential impact on growth. And I think that will be in the back of their mind, of the Fed, later today as well.
The estimates obviously are variable in terms of what the closure of the Straits of Hormuz, if that was an option that Iran went for, would do to oil prices. But some suggesting you're looking at $125 a barrel on oil. You're looking then for hedges around the inflation story. Where does that take you?
Exactly. So I agree with you. There's 3 big themes that I observe being priorities for investors at the moment. One is diversification and hedges, which take multiple components. I'll start with gold. Gold has been obviously, the big beneficiary of both the tariff-induced volatility, but also the geopolitical risk increase that we've observed. And it has done a lot. At the same time, I was with some large Swiss investors last week, and they told me for the first time that gold in their clients' portfolios has moved up from 2-3% historical allocations to now 5-7%. So you see the institutional and wealth investor money coming and continuing to come into the exposure. And we've seen that this year. We've seen 32 billion flowing into gold exchange traded products year to date, vis-a-vis, at this point last year, only
But has the window closed on gold? Because Citi is forecasting gold gets down to 2,700 per troy ounce by next year on rate cuts, on slowing growth.
It's a good question, Tom. So I think that search for diversification from investors at portfolio level will continue, and that will provide support. And then we're reading that central banks are also changing their allocations towards gold, which has now overtaken the euro as reserve currency in their allocations. So I think there's still space there for adoption. I would also flag gold miners as a laggards that can provide exposure to that protection. In general, in terms of broader portfolio themes, market-neutral strategies, systematic strategies are becoming more in favour for investors, again, as a way to protect and defend portfolios. I'm seeing that theme also spilling over into equities. So if I think about US equities there as well, it's difficult to avoid the US in terms of corporate resilience, corporate strength, earnings. You still go there. At the same time, it's important to do so with defense, thinking about minimum volatility strategies or, opportunities to buy on deep into high conviction trades. We mentioned earlier, financials, bank potentially benefiting from further regulatory loosening, or AI being the other one.
When we talk about inflation, we think as well about the BOE. That decision's tomorrow, but the inflation risks on higher oil posing arguably a challenge for the Bank of England. Given the inflation data that came out of the UK today, higher than estimated, the highest level since for this year, 3.4% on CPI. Is the risk to more dovish rhetoric from the BOE and that tilt to a more dovish BOE, does that still hold up in face of the oil risks and in light of the inflation data we had today?
I agree with you. It doesn't make it easy for the BOE because the inflationary component has been already there, and what we are observing at geopolitical global level further adds to those concerns. We expect a hold as well and a continuation of the quarterly pace going into August and then November. But you're right that among the central banks, the BOE has one of the most interesting conundrums to balance out.
Where are you finding opportunities in the gilt market? I mean, we're weighing up slightly softer data. We're weighing up where the BOE goes. Are gilts offering a premium that is looking attractive at this point?
It still does, and it's a great question in terms of locking in income, which has been a big theme in fixed income overall. So if I look at May, we've seen the highest adoption of fixed income ETFs, second highest on record. So you can see investors coming into the asset class with conviction. And arguably, if I look, for example, at European credit, it isn't cheap. But every time spreads widen, you see this pool of money coming in. I think gilts are an area where this idea of locking in income also comes through and still remains an opportunity for investors.
Bank of America, their fund managers survey, and the results suggest that there is a view that global stocks outperform US stocks over the next 5 years. We've clearly seen that outperformance of European stocks versus their US counterparts this year. It's not something that's happened very often in the last decade or so. Do you align with that view? What are the flows showing you in terms of that appetite for European stocks and global stocks over their US counterparts?
Yeah, the flows have been remarkable year to date. So just to put things into perspective, if I look at where we were in 2024 last year, we would have seen 12 billion going into European equities. Year to date now, 60 billion, so 5 times what we observed.
12 billion versus 60 billion.
Exactly. And this is at global level. Of that 60, 45 billion coming from European investors. So to your point, entering and coming back to the market and funding the positions from US equities. Last year, at this point, European investors would have bought 27 billion, year to date now 10. So you can see that rotation really unfolding. Look, I think Europe is still very much a selectivity story in terms of acknowledging this repatriation trade. There are elements there around the importance of selection, which you can capture through active strategies, or you can capture by looking at sectors such as banks, which we continue to favour, or defence. I was looking at the underlying index of one of the ETFs that we recently launched. It has done 100% year to date, and yet speaking with our analysts in the fundamental equity team, they tell us that the sales growth for the sector are expected to grow times 4, times 5 over the next 3 years. And so again, you see that trend not having finished. So again, Europe, there's money in motion significantly. Selectivity is the way forward, and defence is a good area to continue.
Okay, that's really nicely summed up. The flow show continues into Europe, but be selective. Ursula, thank you very much indeed, with views, of course, on the Fed and the BOE as well. Ursula Marchioni, EMEA's Head of Investment and Portfolio Solutions at BlackRock. Coming up, we're going to talk Fed and dollar with a focus this time on FX. We're going to bring in Elsa Lignos, Global Head of FX Strategy at RBC Capital Markets. Well, longer term, still has a view on weak dollar. We'll unpack that next. This is Bloomberg. Welcome back. Fed officials widely expected to leave interest rates unchanged for a fourth straight meeting later today, with President Trump's trade policies adding, of course, to uncertainty around the economic outlook. But they may telegraph their intentions via revised forecasts or the dot plots. We're joined now by Elsa Lignos, Global Head of FX Strategy at RBC Capital Markets. Elsa, thank you for joining us in this studio. We were just talking to Ursula Marchioni from BlackRock. Their view at BlackRock that you still get 2 rate cuts from the Fed by the end of this year. Do you align with that view? What pulls the Fed off the sidelines?
That's the RBC view as well. The risks, of course, are skewed towards a later start, but if they do start later, they may have to go a bit faster into 2026. So I think the end point stays reasonably the same, around 150 basis points of cut through the middle of next year. OK, 150 basis points of cut through the middle of next year. What today are you going to be scrutinising? It's one of those meetings, again, where we're expecting a hold. So it's the press conference, it's the updates around inflation, around jobless and the dot plots. What for you is going to draw your eye? I mean, the reality is there are a lot of expectations baked into this meeting, particularly after the last meeting was such a non-event. Powell very much in wait-and-see mode. And as our head of rate strategy put it, this is going to be wait-and-see with some dots. At the same time, if there is a risk that the tone shifts, it may be towards the more dovish side. We have seen some softening in the labour data. We've certainly seen some downside surprises in CPI. Offsetting that, there's still the uncertainty both around tariffs and around events in the Middle East and the pressure it puts on oil prices. And so I think all things considered, we expect the Fed to remain on hold with 2 dots for the rest of the year. OK, still 2 dots for the rest of the year. OK, so we'll watch those forecasts and see if that aligns with your view. Bloomberg reporting today as well, and looking at some of the pricing in the options markets around 2026, and particularly after Jay Powell steps down in May of next year, and ramping up bets that essentially get a more dovish head of the Fed. Is that the right way to be thinking about it, given the pressure that President Trump is putting on the Fed at this point? Yeah, the president has put a lot of pressure on the Fed, but at the same time, I think very much depends who you get stepping into the seat of chair, how widely respected they are by the rest of the board, and also, frankly, what the economic reality is on the ground. I mean, the truth is that we are seeing that softening starting to creep into the data. Retail sales yesterday, not fantastic. You know, household consumption has been held up by higher incomes, effectively spending their way through any slowdown. That may also start coming off. So I think as we go into 2026, it is reasonable to expect that we are going to be seeing rate cuts from the Fed.
I want to quote from your notes to us. This on the dollar. In the long term, we maintain our conviction that the dollar is on a structural path lower. Just unpack that for us.
Sure, there's a lot of factors playing into this, and there are some structural but also some cyclical factors as well. If I start with the cyclical, we went into this year with a strong belief in US exceptionalism baked in. Now, that's not to say US exceptionalism is completely dead in the water. The US still has stronger productivity growth than a lot of other places in the rest of the world. But at the same time, what we're seeing is a convergence between US growth and the rest of the world. We've seen the upward revision in European expectations, downward revision to the US, and so that naturally is going to lead to a convergence, we think, in terms of front-end interest rates as well. In turn, that will drive the cost of hedging, which we think is really impactful both for euro-dollar and for dollar-yen, and that underlies our forecast for 120 in dollar-yen by the end of next year, 124 in euro-dollar. On the structural side, there has been a very long-term allocation or overweight allocation to US assets. You touched on it with your previous guest. And we are now beginning to see that reverse to some extent. I mean, it's still early days. We don't want to get ahead of ourselves. And, there's a lot of talk around de-dollarization, but the truth is these are events that take a very, very long time to play out, long-term factors rather than something that happens overnight. But it is true that we are seeing a kind of slow reduction of allocation to US assets and an increase to the rest of the world.
How fundamental is the breakdown in correlation between the dollar and the 10-year yield?
So for me, what's really interesting at the moment is not so much that breakdown, so much as the breakdown between the dollar and certain the dollar against risk proxies and equity markets.
Okay.
And the reason I say that is, take Canada, for example. We focus a lot on Canada being the Royal Bank of Canada. But historically, you would have seen a very strong inverse relationship between dollar CAD and equities. So what that meant is that for Canadian investors holding long US equities, they were kind of naturally hedged by the currency to some extent. Now, as you see that correlation diminish, almost reverse, it actually incentivizes people to start thinking about putting currency hedges on, and that in turn leads to another source of selling pressure for the US dollar.
The yen, I mean, you just mentioned there, you see further upside for the Japanese currency. What assumptions are you making about BOJ's moves above 0.5% right now on their benchmark rate? How far do they take it, and how much of that is going to be supportive to the yen? How much are you assuming in terms of where the BOJ goes?
It's a good question. I think realistically more of the convergence is going to come from the Fed cutting rates rather than the BOJ necessarily hiking. And I think if you look at the hedging behavior of lifers, they do tend to follow the cost of hedging fairly closely. So we've already seen an increase in hedge ratios since October of last year through to April, May, when we got the latest semi-annual investment plans, an increase of about 5 percentage points. That has a lot more room to run. So if the cost really does come down materially over the next year, those hedge ratios could raise by another 20-25 percentage points.
OK, Elsa, fantastic breakdown of the FX space. We didn't get time for the pound, but next time. Elsa, thank you very much indeed. Elsa Lignos, Global Head of FX Strategy at RBC Capital Markets, with that longer-term view as well on the cyclical factors and structural factors around the greenback. Coming up, oil markets continue to swing, of course, as Middle East tensions build. We get a take on the commodity markets next. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Tom Mackenzie in London. These are your top stories. Speculation grows that the US may join Israel's attack on Iran as President Trump met with his national security team after calling for Iran's, quote, unconditional surrender. In markets, oil hovers near a 5-month high on the escalating Middle East tensions as investors also look ahead to today's Fed rate decision. Plus, Meta's millions. OpenAI's Sam Altman says Mark Zuckerberg has been poaching AI staff with signing on bonuses of as much as $100 million. Let's return to our top story now, though. Of course, Israel and Iran have exchanged fire for a 6th day as speculation grows that the US might increase its involvement in the conflict. Bloomberg understands Donald Trump had a meeting with his national security team yesterday, having earlier called for Iran to surrender. With me now is Ros Mattison, Bloomberg's EMEA news director. And Ros, we've just been seeing some lines crossing from Iran's ambassador to the United Nations. What have we been hearing from Iran's representative?
Well, these comments come after the US President Donald Trump said that he called for Iran's, quote, unconditional surrender. And we saw the Supreme Leader Khamenei last night again say they're going to keep going. And echoing that, we see the comments from the ambassador to the UN speaking in Geneva saying, you know, if the US gets directly involved, and that's like right now what they've been doing is helping Israel repel attacks, if they take on an offensive role in this conflict between Israel and Iran, that Iran will come for US assets in the region, military assets. That's a line that Iran has been saying repeatedly. I mean, they're already saying, they said that the US, they say, is complicit in this conflict already. So there's nothing massively new in that, but another sign again that, you know, there is a risk of this conflict broadening, because if Iran does decide, for whatever reason, to hit US assets, that's going to bring in a whole lot of other countries potentially in the region. What are Iran's other options at this stage, given what we know, and there's a lot of uncertainty as to Trump's next steps? What are their options? Are we in kind of regime survival mode at this point, or we're not quite there? Well, possibly we are. I mean, a lot depends, obviously, on the US deciding what it wants to do. But from Iran's perspective, you've potentially got a number of options, and one of them is making that choice between preserving their nuclear program or turfing that in order to focus on regime preservation and finding a way to hold on to the regime there. Obviously, they have to manage the messaging on that at home. It's very difficult. But do they make that choice to jettison some of their nuclear program in order to keep the regime intact? Do they decide to try and broaden the conflict? Because, dare I say, if you start striking other assets in the region, you're going to bring in a whole conversation around NATO and collective defence for the US potentially. And do you do that to sort of see if you can really exploit differences between Europe and the US? I mean, it's a very risky gambit, but do they say that they feel they've got no other option? Or do they just hope that somehow, you know, this tapers off a little bit and returns to a semblance of something else for now? Most unlikely, given, you know, the perspective from Israel, but, you know, that's probably some of the conversations that will be happening inside Iran. What is our understanding of Trump's decision-making process at this point? A president who we understand has aspirations for winning the Nobel Peace Prize, for example. How close are we to President Trump potentially making this momentous decision, and what could the risks be for the US? Well, the risk could be very significant. We've seen the trajectory, though, of Donald Trump really not wanting to allow or encourage Israel to attack Iran, and then to essentially largely backing the Israeli position. And does that extend to the next bit, which would be the US militarily supporting Israel and saying, at this point, we need to get in there and just try and get this job done on Iran's nuclear facilities once and for all? There's probably a lot of conflict going on within the group around Donald Trump on that. You've got Republicans who say we shouldn't be getting involved in conflicts overseas. This is not our business to be stepping in militarily. We should be letting Israel get on, but it's not for us to do. To others saying, you know, very much like wanting regime change in Iran and saying you've got to keep pushing on this. So conflicting views in his administration. Where does he lean in all of that? And as you say, the risk again is that if you do get directly militarily involved, is that going to prompt some kind of reprisal within the region directly targeting US assets? OK, Rosalind Matheson, thank you very much indeed, with an important update, of course, in terms of how this conflict continues to unfold and the next steps for the US president and his team, of course, in terms of their involvement. Now, Italian Premier Giorgia Meloni, meanwhile, is pushing G7 leaders to support a ceasefire in Gaza amid the escalation of hostilities between Iran and Israel. Meloni says she's found agreement with many of the leaders that she's spoken to in recent days. Meanwhile, worth reminding our audience that in Gaza, the city's health ministry says at least 51 Palestinians were killed and more than 200 wounded in an incident while waiting for aid trucks. The Israeli military acknowledged several casualties after they opened fire on a crowd and said authorities would investigate the incident. US President Donald Trump has resisted, meanwhile, G7 calls to impose new sanctions on Russia, despite urging a ceasefire in Ukraine. However, Canadian Prime Minister Mark Carney unveiled new measures to support Ukraine, including $1.5 billion in military support.
The importance of using maximum pressure against Russia, who has refused to come to the table. The president has led unconditionally to come to the table in search of peace. And maximum pressure includes financial pressure.
Let's bring in Oliver Crook from Berlin, who's following this for us. So G7 leaders, they couldn't convince Trump ultimately, Ollie, to impose tougher sanctions on Russia. What were the sticking points for the US? What held them back?
Yeah, so there are two really avenues by which the United States could help exert some more pressure on Russia from the European perspective. One would be for the U.S. to join in on this idea from the EU and the U.K., who came to the G7 hoping they could get Trump on board to basically lower the oil price cap that currently exists on Russian crude that's being sold across the world from $60 down to $45. That is something that the Europeans, I think, quite optimistically wanted to get Trump on board for. And obviously, the U.S. administration doesn't really like to follow anybody in terms of their policy going across the world. Trump likes to set policy and have others sort of follow behind them. What we got instead, of course, is the Trump administration. The other sort of side of it is the secondary sanctions that Lindsey Graham has prepared from the U.S. side that the Trump administration and Trump himself does not really seem very convinced by, right? There is bipartisan support in the Congress for the United States to move forward on this, but Trump is still basically not convinced. And he spoke most recently with Vladimir Putin on Saturday on Trump's birthday, talking about Iran among a number of other issues. But really, I think the fear for the Ukrainians is that this becomes, as the Iranian sort of conflict begins to expand and continues to expand, comes further and further to the back burner. And as a consequence, the Ukrainians basically fall short and become sort of forgotten as basically the rest of the world is dominated by all of these other issues that are going on. And of course, the Europeans wanted to get Trump further on side with Russia. This is the thing they've been trying to do for months and months and months and failing to do so. And what Trump ended up saying was that basically the G7 were to blame for the war in Ukraine because it was because of the G7 that expelled Russia from the G8 that Russia invaded Ukraine. Of course, we remind everybody that the reason that Russia was expelled from the G8 was because of their initial annexation of Crimea back in 2014.
Yeah, and that's an important reminder, isn't it? So Carney stepping up, the Canadians stepping up with more support for Ukraine, even as Trump remains on the sidelines. Ollie, is this how it goes from here, that individual nations, whether it's Canada, the UK, the French, the Germans, individual support for Ukraine, and is that going to be enough to tie Ukraine over?
So listen, Tom, let's think about how this aid has basically been structured over the last 3 or so years that this war has been going on. It has been U.S.-led. U.S. has done the majority of the deliveries in terms of the military hardware. The EU has put up a lot of money, but it has really been anchored in the United States and its military equipment. What we had was a last package from Joe Biden. We understand from the sort of information that we have that will basically expire by the sort of end of the summer. That leaves a huge hole for the Ukrainians, and that is a hole that will increasingly have to be filled by individual nations and the EU. And going toward that end, Mark Carney stepped up over the last couple of days and put forward that $1.5 billion worth of military aid to Ukraine. He also boosted sanctions on the Russian shadow fleet. This is one of the main arteries by which the Russians are still financing the war, and he's called basically for maximum pressure. The problem is that the EU and the sort of G7 x the United States, they're limited in what they can do. They've basically come close to maxing out what they can do on sanctions. There are a few other things they can do, but really the U.S. holds the chips on that. Even with Russian gas, the EU has been talking about finding a way to basically ban Russian gas from their systems by 2028. They do not have consensus within Europe to do that. So again, as we see these things escalating, there's not consensus within the Europeans. For the Ukrainians, the key question is going to be who is going to be able to step up. The Germans have stepped forward. The Canadians have stepped forward. We'll see how much further support they can give over the coming months.
OK, Bloomberg's Oliver Crook in Berlin. Thank you very much indeed with the update in terms of the support or lack thereof for Ukraine as it continues to face pressure, of course, along its front lines from Russian forces. Now, oil continuing to fluctuate after rallying some 10% since Israel started its attacks on Iran last week. Joining us now is Sloth Hansen, Head of Commodity Strategy at Saxo Bank. Ole, thank you for your time and thank you for waiting patiently in the wings as well. So we're seeing fluctuation around the oil price today. Brent is down 0.5%. WTI is at $74 a barrel, also a little softer by 0.4. There is this volatility in the oil markets. How much of a risk premium is priced in at this point?
Well, good morning, Tom. Quite a bit, I would say, considering that if we disregard the current turmoil, Brent crude prices should probably trade below $70 given the fundamental outlook as we have it right now. So there is a premium in. And obviously what is the concern in the market is that premium could explode even further if we have an actual blockade of shipments coming from the region, especially through the Strait of Hormuz. And I think that's really, so we're basically facing a binary option here where we could see prices sharply higher or sharply lower. And with that in mind, we're seeing quite a lot of the activity being concentrated in the options market simply because the fundamentals does not support higher prices, but again, the risk does. So with that, we're seeing calls being priced quite significantly over puts right now.
Okay, so there is that binary direction for oil prices, depending on how this story in reality, of course, unfolds. What is the potential upside for oil, Ole, on and in a situation where Iran does go for that chokehold on the Straits of Hormuz?
Well, I would say it's anyone's guess because there is obviously inventory levels around the world, especially in China, that could be put to work initially to mitigate some of the upward pressure. But as we saw that 13% spike on Friday, just the risk of something happening, and so the market is very spiky, and the risk of a further move higher is obviously there. So the move, if we are seeing 20% of the world's supply being locked in for a period of time, then obviously we will see prices move above 100 to a level where we start to have a negative impact on demand in order to balance the market.
Is there a demand destruction story at this point, given the geopolitical risk, given the uncertainty, given some of the weaker data out of the US and a China that's still not firing on all cylinders?
I wouldn't say so. We've kind of come accustomed to this kind of range. We're a little bit above the range that we saw earlier this year, but not to the extent that it's having a profound impact. Also, we have to remember this was happening probably at the worst possible time for crude oil, simply because it was on the rise, because we are going through a strong period of summer demand, as we always are, driving more, flying more, and using more energy towards cooling. So it hit the market at a time where demand was already strong before the expectations were for pointing towards slower and easing demand into the autumn months, which then could add downward pressure. So I was saying at this point in time, even though refinery margins are moving higher, diesel costs in Europe is quite a bit higher than the last week, but still probably not enough to have an impact on demand.
Does any of this, given the known unknowns, does any of this change the calculus, do you think, of OPEC Plus?
Only that they're still needed as the regulator of supply and demand. They have been adding supply for months now, and that has not really had a negative impact on price. And now we can see that it was needed, but it's difficult to say. We need to get on the other side of this to see whether the unity can be maintained, because there's no doubt that the OPEC Plus is run by a few countries, and while the others try to follow suit. So we'll see when we get past this.
Ale, I want to get your views. You touched on China. The IEA came out earlier this week with a report suggesting that they were bringing forward their forecast as to when we get to peak oil demand, with China really kind of in focus within that report. Does that ring true to you in terms of peak oil demand?
I think it does, considering the phenomenal rollout that we're seeing right now in China towards electrification. They are really leading that charge, and if that continues, then we will see an eventual rollover of demands starting to taper off. And then the question is really what kind of strength we'll see from other still growing energy consuming nations like India, and then eventually we'll see what kind of impact it has on the overall level of global demand. But we are getting close to that point where the focus in the market will probably be less on China and more on some of the other growth countries.
Okay, that's really interesting. The demand focus switches from a China that electrifies maybe to some other larger consumers within the emerging markets. Gold currently, I want to get your views on the yellow metal. Gold a little softer in the session, just down a tenth of a percent. Of course, it's had that pretty startling run-up year to date for the yellow metal. Currently at 3,384 per troy ounce. What is your view in terms of where gold goes from here? How much is priced in? Citi coming out with a view and a forecast that the gold basically is as good as it gets right now, and it's heading towards 2,500, 2,700 maybe by around the middle of 2026.
That would be an obvious answer to a market that has rallied as hard as it has now for a while. But we have to remember that a lot of the reason for this rally is basically central banks taking gold out of the market, putting them into vaults where it's probably going to stay for a long time. And that's tightening the market and moving metals away from the market. And at the same time, we actually have quite a reasonable low investor demand if you look at futures and ETFs. So that is still could still spring to life if we see the funding costs come down further. And then so I think in the short term, the focus is really on the direction of U.S. interest rates. I believe that gold is looking tired. There's no doubt about that. We're going through a period of consolidation here. It could potentially fall further. I'm not concerned as long as it stays above 2,900. And in the meantime, we're seeing some of the smaller metals being allowed to shine. So we're seeing a phenomenal run up recently in both platinum and silver. And then obviously they don't have the same problem as gold. They're still quite a far away from their previous record highs. So that basically makes it a little bit of an easier investment decision for some at this point in time. But I think going forward, gold needs lower funding costs, the lower interest rates in the US for it to push back up towards 3,500 and beyond.
I was like, to be clear, there's a catch-up trade when it comes to silver.
There is indeed. The silver is, as I always say, silver is gold on steroids. It tends to move faster in both directions. We had that significant slump during the Liberation Day panic back in April, and since then it's slowly recovered. Right now it's trading around 91 ounces of silver to 1 ounce of gold. That hit a peak above 105, but the long-term average is closer to 80. So just based on that, return towards the average price could see it outperform further. So I think the market now, having moved above 35, having moved above 37 yesterday to a fresh 12-year high, then obviously 40 will become the next psychological level that the market will be talking about. So we'll see now. We just need to gain a foothold above 37 to see whether we can actually make a push towards that level.
Okay. Olo Sloth Hansen, head of commodity strategy at Saxo Bank. Gold looking a little tired. Silver is gold on steroids. Appreciate the insights into this commodity space. Thank you. Coming up, we're going to switch focus because OpenAI's Sam Altman says Meta has been offering signing bonuses, get this, of as much as $100 million to poach top staff. We all should have worked harder on maths. More on the increasingly expensive AI talent race. That is up next. This is Bloomberg. Welcome back. So the Federal Reserve, of course, is expected to leave interest rates unchanged for a fourth straight meeting later today, much to Trump's ire, no doubt. This as Fed officials continue to weigh the impact of the president's trade policies on the economy. For more, let's bring in Bloomberg M9 strategist Ven Ram on what to watch then from the press conference and the updates around the forecast. We've had two guests on, Ven, so far on the show, one from BlackRock, one from RBC Capital Markets. Both see dot plots pointing to an additional two cuts, or at least two cuts in 2025, so reaffirming the market views. Do you align with that, or do they adjust the dot plots lower?
Hi, Tom. Good to be talking to you. Yes, I'm very much aligned with what your guests have said. I think two rate cuts is what the Fed is going to prepare the markets for, because if you look at the March dot plot, Tom, I mean, they already slashed the growth rate from 2.1% to 1.7%. So I don't expect too much of a revision on that front, because if you look at the Fed Atlanta GDP, it's pointing to a robust expansion in the second quarter. So I think they are going to be pretty comfortable with that 1.7% forecast. If you look at core PCE, yes, it's trending lower, and they will probably pencil in a slightly lower number, albeit I think they will stay with two rate cuts because they probably do not want the markets to get ahead of themselves, especially in a scenario where there's still too much uncertainty about policy and there's uncertainty about how the tariffs are going to impact inflation down the line. With that known unknown still weighing on the Fed's minds, they are unlikely to be throwing caution to the winds and indicate more than two rate cuts. So I think two rate cuts is what we are going to get, and that's what the markets are going to take away. And that means that the front end is going to be pretty anchored around 4%.
Okay, so the front end anchored around 4%. Two cuts likely to be signalled by those forecasts, by those dot plots. To the UK, then, I know you keep an eye as well on the data out of the UK and how that ties into thinking around the BOE, which, of course, steps up with their decision tomorrow. So higher inflation data out today, higher than estimated, at least. To what extent does that tie into the BOE's thinking? Do we get a more hawkish BOE than maybe some had suggested?
Yeah, I think that the BOE is likely to be more cautious going forward. Look, we got what did the inflation report today show us? It showed us that core inflation is bobbing around 3.5%, retail inflation around 4%, and services inflation is closer to 5%. None of those numbers are telegraphing any confidence to the market that a 2% inflation target is likely to be attained anytime soon. And if you look at crude prices in the past this month, they have surged about 20%. So the BOE, the UK economy is particularly vulnerable to imported energy inflation, and therefore the BOE is likely to turn more cautious. We already had Pill saying last month that, look, he's doubting that the speed at which the BOE is going, i.e. the BOE is going at once a quarter pace, and the Pill thinks that even that is too fast. So I think that the BOE has all the incentive to turn more cautious tomorrow. Of course, nobody is expecting any action. So I think that the markets are thinking that the terminal rate is going to be around 350. I think that the terminal rate is more likely to be around 375 or 4.
OK, Venram, thank you very much indeed from Bloomberg M Live with a look ahead to both the Fed and the BOE, folding in that inflation data out of the UK that came in slightly higher than expected. Ren, thank you. Now to the UBS story. This is pretty fascinating. UBS says a cyber attack and an external supplier has led to information about the Swiss bank and several other companies being stolen. But UBS says, this is also important, of course, that no client data has been affected. Information on more than 130,000 employees has reportedly been published on the dark net. That is according to Swiss newspaper Le Temps. The data set includes the direct phone number of CEO Sergio Ermotti. Now, on tech, OpenAI Sam Altman says that competitor Meta has offered some of his staff signing bonuses of as much as $100 million as the race for AI talent ramps up. Charlie Wells is here with the latest $100 million bonuses. Charlie, what on earth is going on?
And those are only signing bonuses. That does not even include the
That's
annual,
just a signing bonus?
Yeah, that does not even include the annual compensation, at least according to what Altman said on a podcast with his brother. Meta has not responded to comment there. This is, of course, a sign of that talent race heating up in the AI space. And we're going to hear a lot of noise, I think, about this today. But there is another issue to focus on here, which I think is interesting, which is a lot of these big tech firms have learned about the threat of antitrust. And at this stage in the process of the development of this technology, they may be concerned about acquiring full firms. So instead, what some of this strategy seems to be is you make an investment in a startup and then you poach talent and bring it into the fold at your much larger tech firm because of that looming issue that so many of these firms have about antitrust. So I think this is what this gets at, this huge race for talent, but also this concern about acquisitions.
Charlie Wells, thank you very much indeed. Plenty more coming up. Bloomberg Brief is up. This is Bloomberg.